Good afternoon, everyone. Uh, Welcome to this exclusive live webinar hosted by InCred Premier. Today, we are excited to bring you an insightful session on InCred Growth Partners Fund. This is a pioneering private equity strategy from InCred that focuses on best-in-class companies and aims to unlock substantial wealth growth opportunities for investors. Our keynote speaker today, Vivek Singla, is managing partner in InCred Alternative Investments Private Limited. He brings over 2 decades of experience, having successfully led 20 plus investments in high growth Indian companies across consumer, technology, enterprises, and financial services sectors. As the head of the fund, he is spearheading the growth of InCred's private equity franchise. Vivek has a PGDM from IIM Lucknow. He's a BTech and MTech from IIT Delhi and is a CFA charter holder. Today, throughout the session, we'll be exploring what are the unique potential opportunities of investment in alternate investment funds for wealth creation, and what are the practical insights into navigating current financial markets. Also, a bit brief on what exactly are private equity markets. So please be prepared to gain actionable perspectives that will empower you to make informed investment decisions and stay ahead in today's dynamic landscape. Vivek is a fantastic fund manager and you should pay close attention to him. Over to you, Vivek.
Thank you, Sahil. Very good afternoon to each of you. Thank you for joining us today. And as Sahil mentioned, we specialize in running private equity strategies. I run this fund at InCred. Private equity is an alternate asset class where clients come when they are looking for a higher return or an alpha. I meet clients, throughout the length and breadth of this country, and I think the common problem that I'm finding across clients when they're coming and talking to me, the single biggest problem statement that they highlight is that they tell me, Vivek, last 5 years have been very good for me. I have been investing in the stock market, I've been doing mutual funds, I've been doing PMSs, and I'm sitting on a 25% CAGR, I am sitting on a 30% CAGR, and I've made my 100 rupees into 300. But now I'm a little nervous because what is happening at the geopolitical level, what is happening at the currency level, I find things to be very choppy. And the last 1 year has been a sort of a very turbulent time for both the markets as well as for me. So how do I continue to keep generating the returns that I was generating? I don't think I am able to generate that same 25% return that I was doing it earlier. That is the single biggest, I think, common problem statement that clients from Delhi to Chennai, from Bhubaneswar to Pune are telling me today. And I meet clients across industries, across age groups, across, backgrounds, right? So we tell the clients that what has happened in the post-COVID era is a frenzy, which probably is a very unique time period where very few of us have lived through that era, and it may or may not repeat. It's very highly likely it will not repeat. So do not expect the markets to keep going up as a broad-based index or as a broad-based theme. Increasingly, returns will be made by being very stock specific, by being very company or asset class specific. So you have to start looking at asset classes which are beyond what is available or accessible by every other investor. Which is why you should start looking beyond the obvious and start getting into alternates. This is where we come in. We have been doing this for the last 20 years, and our thesis is that we come in into unlisted companies with the objective that these companies which are unlisted are available, or we are able to access them, or invest into them at valuation multiples or at valuations which are discounted compared to the listed valuations. So we will typically come in maybe 3 years, 4 years before a listing and able to extract some discount while coming in. So we are able to dictate our prices while we are entering the company. And as we bring our companies out for a listing, the valuations of the private markets, they converge with the listed markets, and that's where we extract our alpha. So we play two things rather. One, we play the growth in the business, which any other investor also plays, but we also play the growth in the valuation multiple. And that happens because we are doing an undiscovered story, a story which is yet to be, discovered by the larger market. And most importantly, we are able to dictate the entry time and the entry price point. So if the deal is not available at my valuation, I'll rather not do the deal only. A case in point, we have recently done a deal in the consumer electronics space, one of India's largest companies. The listed multiples are in excess of 40-50 times EBITDA, whereas we have come into this company at even literally half the multiple. And we are going to bring this company out for an IPO. As per our plans, we will bring this company out for an IPO in the next 2 years. And the thesis is that as this company approaches a listed market, our valuation multiple that we've paid half will converge with that 40-50x EBITDA, and we will get a 50%, maybe 100% upside purely from the valuation multiple, in addition to growth in the business. So if you have to keep generating that alpha, you have to start looking at alternate asset classes, within which private equity is that asset class, which is designed to give you, at least in our case, we are sort of targeting an alpha in the range of about 15% over what a Nifty can deliver over a long-term basis. So if a Nifty or a small cap index ranges between 12 to 15%, our target is to deliver a 25 to 30% kind of a return on an IRR basis. And this we do by not taking extra risk. We do it by doing large cap companies just 2 or 3 years before a listing. So we give that alpha, but we do not take, and I reiterate, we do not take any early stage risk of a VC fund. So our portfolio companies are late stage companies, big companies, profitable companies, which are almost on the verge of an IPO. We've been doing this for the last 20 years, as Sahil was kind enough to introduce me. Have had the fortune of working with some very good marquee names like Stanchart, Kotak, CLSA, and my last job at Avendus before I started my journey with InCred. And the names that you see below are my past portfolio companies. And these are all, as I think a lot of you can appreciate, big companies. So a Lenskart today is an $8 billion company. A Bikaji would be about a $3 billion company. NSE, Nivabupa, SBI, Delivery, Ujjivan, Equitas. These are all names which were market leading names. They were all big companies. And especially if you look out of these maybe 25, 27 names that we've put down there, the ones in the boxes are where we've already delivered an exit. So we've come into these big companies, and quite a few of these companies we've already taken them IPO. And as I mentioned, as we bring these companies out for a listing, the valuation multiples converge with the listed multiples, and that's where we make the alpha. So we have done our first fund, which is doing a very good IRR. We are tracking almost a 30% kind of an IRR, which is why we have launched our second fund. It's called InCred Growth Partners Fund 2. For those of you who have been part of our journey all this while, thank you so much for your trust and faith. For those of you who are joining us now, trying to understand the markets, trying to understand the product, while obviously I will take you through all the details, but my request would be to keep this session very interactive. Happy for you to even ask us question, post this conversation. Sahil can share my details. We're happy to be taking you through any doubt or any clarification. So the name of the fund is InCred Growth Partners Fund. We are now into a second fund. This is a private equity fund which focuses on growth and late stage companies. It's a category 2 AIF. We are regulated by SEBI. We just got an approval from SEBI about 10 days ago, and we've been raising money for the fund for the last 4 days. I'm very happy to share before the beginning of this presentation that in the last 4 days itself, we are sitting at almost 150 CR of commitments, which have come in largely from the Fund 1 clients. So the Fund 1 has done so exceedingly well that a lot of the clients have taken subscriptions in the Fund 2 also. The fund, we call it IGPF for short. It invests in 2 stages. If you see that arrow in the first row, we invest into 2 stages. Late stage, which are companies just on the verge of an IPO, and growth stage companies which are maybe 3 or 4 years from an IPO. And this is a portfolio that is designed to give you both stability as well as growth. We've been in this business, running it for the last almost 2 years now. Our first fund, we call IGPF1. We have done 7 portfolio companies. It's tracking, and I'm very pleased to share this, 30% IRR. And we will have in the near term, in the next 12 to 15 months, 4, if not 5 companies publicly listed and traded. Such is the performance of this first fund that our second fund, we've already garnered a very good commitment base in just 4 days of about 150 CR, right? The other thing to note is, and I'll come back to this point, is that we target companies which we call best in class. Best in class is basically how we look at companies, the size, the scale, the profitability, and basically the attributes of the company. And we look into these companies on a proprietary basis. That means we don't just rely on advisors, consultants to bring us deals. We participate in companies where we will directly know the promoter or the founder or maybe somebody in his senior leadership team directly over a period of time. This direct connect between us and the promoter or his board member or his leadership team allows us an early entry, and at the same time we stay ahead of the curve and we are able to generate that alpha, which our first fund is demonstrating. A very quick snapshot on where we are in Fund 1. For those of you who've been part of the journey, you would have seen the performance. Again, for those of you who are joining us new, this is just a very quick snapshot. First fund, we did about 600 CR of total raise, out of which we have, if you see that circle at the top left, we have called 70% of the clients' money so far. This is invested into 7 deals. I'll come to all of them. And our portfolio is recording a 30% IRR. We still have 5 years left to go in the fund, and we are very hopeful of the performance going forward as well. Looking at a multiplier of your money in the next 3 to 5 years. But before I go into the fund's performance in particular and what we are doing for Fund 2, I want to explain to you how the product works, so that all of you are comfortable on how the cash flows or the capital calls come in, and when do the clients start seeing their money back. So this is a short duration private equity fund. It's a fund where the money comes in for the first 2 years. We do not take the money down in one go. There are some fundamental differences in how a listed fund works versus how an unlisted fund works. In a listed fund, like a PMS also for that matter, whenever you commit to that fund, you have to part with your entire money in one go. And sometimes it becomes very onerous for the client to participate because check sizes of 50L, 1 CR are generally not many clients would have that liquidity in the near term. We have tried to solve it by giving the clients time to pay. So the money comes in over a 2.5 year time frame. So if you are sitting, for example, in September 25, today we will take down 10%, which will be upfront at the time of signing 10%. And that is for a deal which we've already identified and signed. The remaining 90% of clients' money comes over the next almost 2.5 years. So from, let's say, September 25 till December 2027. Every 3 months, we'll end up doing one deal and take about 10 to 15% of the client's money. So let's say 10% in September, then maybe an additional 15% by February or March, and then June, September, December next year. Similarly, March, June, September, December of 2027, we will keep calling the money in stages. Every time 10 to 15% of the commitment. We don't take money in one go. That's number one difference. The number two difference is that we do not charge clients on the amount of AUM that is lying with me. So for example, if you've given me 100 rupees, I will only charge you on the 100 that you've committed with me. In the case of a listed fund, let's say the markets have gone up, 100 has become 200. The listed fund will charge you the same management fee on 200. So if it was 1% on 100, that is 1 CR, it is 1% on 200, which is 2 CR. So the fees becomes very expensive for a listed fund once the markets are rising. On the other hand, in a case like ours, even if you are making 100 into 200, we continue to charge you on the 100 that you've committed with me, right? So our model is not to work on fixed fee. We want to keep our skin totally aligned with that of the client. We work on profit share. If you make a certain profit for the client, then you participate in that profit, and that is our skin in the game. If you make money, then we make money. So it's a 6-year fund. The money will come for the first 2.5 years. And then let's say December 27, we have taken the entire money down. From beginning of 2028, maybe, June 28 or March 28, we will start returning the client's money back. So the client should expect their money to start coming in during 2028, 29 and 2030. So over a 5-year period, the entire money, or a 6-year period at the outer limit, the entire money will come back to the client. So if you look at it, it's a period where, your entire money stays with me only for 3 months. That is from December 27 till maybe March 28. So it's a very limited window where the lock-in is there. Otherwise, the money comes in stages and you start seeing liquidity coming back very, very quickly. It is one of India's shortest private equity funds. So 6 years is the outer limit, which we have told SEBI that we will be able to return the money back. And remember, we are a SEBI regulated business. We are a category 2 fund. We are audited by SEBI every 3 months, every quarter. There are other 2 features which are very important to note and which really work for a client to participate in a fund. One, our tax rate has become very advantageous. So because the government ensured that the unlisted space also gets taxed at the same rate at 12.5, we are at parity with the listed space. And obviously the other thing is that most of our companies will go IPO. So once we are listed, then the taxation anyways becomes 12.5. So whether we sell in the listed or the listed space or the unlisted space, the taxation is 12.5% long-term capital gains. And this is by far the most tax efficient product in the market. Below this, there is no product available in terms of taxation. We will deduct a 10% TDS, and it's a pass-through structure. So the remaining 2.5% liability comes on the client. most tax efficient product. The fourth point, no lock-in in IPO, very important for you to understand. We are a category 2 fund, and we are the only type of fund which is allowed by SEBI to sell post-listing anytime. Anytime means 1 hour after listing, 1 day after listing, 1 week after listing. Most of the time what happens, clients, they do direct deals. They have done Swiggy, they have done HDB, they have done Bluestone, NSDL, etc., etc. Even like the case of an urban company which came out with an IPO last week. Massive gain in the stock on the day of listing. Clients feel happy, the stock has gone up 80%, but they cannot do too much because they are under a 6-month lock-in by the regulator. Every shareholder in the company, the entire pre-issue capital of the company is locked in for 6 months post-listing. So you see the stock going up, but you're helpless because you can't exit. We are mandated by SEBI, we are exempted by SEBI such that there is no such lock-in which is applicable on us. So I can technically encash that 80% premium on the stock price after listing. And this is beautiful because most of the time when we are investors in the company, we are effectively running their IPOs. We are investors, not just shareholders in the company. So the whole IPO process is at some level run by us as investors. We are the ones who select IPO bankers. We are the ones who decide the time of the IPO. We are the ones who decide how much to raise in the IPO, how much should be the primary component, how much should be the OFS component, what should be the pricing of the IPO. And when we're doing that, the IPO bankers feed back to us the demand. How is the demand building up? If they say that there is a very good, healthy demand, we will typically not sell, and we will sell after listing once the pop is there. So because we are an AIF2 fund, we are able to capitalize on these IPO pops because we have the knowledge, but we don't have the lock-in. Any single deal that you do as an individual, you will be locked in for 6 months after listing. So this is a key advantage of considering a fund, that you evade or avoid that lock-in. Then there is something called as a hurdle rate. I'm not sure how many of you sort of read this or heard about it. Hurdle rate is sort of a rate which is a bare minimum return which I need to generate. Otherwise, I am not entitled to any profit share. Remember, I mentioned that we do not charge fees on the AUM basis. So if 100 has become 200, a listed fund will charge you on 200, but we will charge you only on the capital that you have committed with me. On the 100, we don't charge on 200. So our model is heavily skin in the game. We want to work on profit share basis, that if we make money for the clients, we take money. And 12% is that basic minimum profit on an annual basis. That if I don't even make this money, I am not entitled to any carry. Carry means profit share. So this is that minimum return that I have to generate to be eligible for a profit share, 12% IRR. The other equally important evidence of our skin in the game is that our company sponsor, which is InCred Capital, is coming in with about 20 CR of their own capital into the fund. So very, very heavily entrenched and total skin in the game from the parent side as well. A very important feature for you to note is that we are also extending a one-time early bird discount. That is, any client who comes in the first few days of the initial close, that is, initial close is sort of a milestone for us. So for example, if you are raising in the fund, let's say 1200 crores, I will raise half of that or nearly half of that and announce a date which is called initial close. This is the date that we communicate to SEBI, and it's from that day that the life of my fund starts. So when I'm saying that it's a short duration fund, that top left tab, 6 years from initial close, as in let's say if I end up raising my 500 crores or 600 crores by November, then that November becomes the date from which the 6 years start. That is November 2025 till November 2031. That is the life of the fund. And anybody who signs up, let's say before that date, will be eligible for another 50% waiver on the management fee. Now, good thing with us is we are already sitting in the last 4 days at about 150 CR of commitments. We plan to hold our first close in November, but the last 4 days have shown us that we may end up closing or holding the first close even before the first 15 days of October. So my request will be that in case you are interested in this product, would encourage you and urge you to start considering it early, because then you will get this 50% rebate on the fees. So this is to summarize, a private equity fund. We have a 6-year life, let's say from October 2025 till October 2031. The money will come in stages. For the first 2 years, we will take the money, and the last 3 years, we will keep to return the money with a target IRR of around 30 to 35% on the portfolio. Our tax rates are very advantageous, the best, 12.5% long term. We don't have any lock-in, and unless I make a 12% IRR, I am not entitled to any profit share, the key incentive of running a fund, right? And private equity funds, we invest into unlisted companies with the objective of delivering that higher return to the clients. Now, I'll run you through some of the examples of what kind of companies we have invested into, how their financials look like, how much growth are we seeing in these companies, so that you get a good idea of what kind of companies we are going to consider for Fund 2. So this is my first fund performance. First fund, like I mentioned, we raised about 575 CR. We have deployed that into 7 companies that you see at the bottom. These are, I'll run from the names from the left. The first company is a company called ILJIN. ILJIN is a part of a listed group, Amber Enterprises. Amber is a contract manufacturer of electronic components, of mechanical components. They do automotive, railways, appliances, everything. Group is listed with about 25,000 crore of market cap. Now within that, they have a subsidiary called ILJIN, which focuses on advanced electronics. So we are very heavy into PCBs, PCB assemblies, batteries, industrial automation, and then we have this new JV with a Korean conglomerate, one of the largest in the world, to develop advanced PCBs. So it's a very specialized business. This is our latest deal. And if you see the financials tab, 60% CAGR between FY22 to 26. And this year we'll finish at a top line of about 4,200 crores with an EBITDA of 480 crores. So it's a really big company. Technically, we can list tomorrow. 4,200 crores revenue, 480 crores EBITDA with an ROE of 20%. We have invested into this company or signed to invest into this company just recently, about 2 weeks ago. And this is a very attractive deal for 2 reasons. One, we have a IPO coming in January 2027 as per our agreement. And we have a minimum assured IRR to the IPO. We have a convertible instrument, and that will convert at a minimum 25% IRR to the IPO price. If the IPO happens at 100, we convert at 75. If the IPO happens at 75, we will convert at maybe around 62, right? Around 60, 62. So this is a scaled asset, highly profitable, near-term IPO, and with an assured IRR. So a very, very sweet deal. Then we have a company called Sellable. Sellable is a company, if you see at the top, it's a company in the data and AI space. Company has been on a literal tier growth, literally tiering growth for the last 4 or 5 years. I have seen and tracked this company for last 4 years. They were a into FY22, they were a 80 crore business. FY23 that became almost 200, which became 400 last year. This year we'll touch 600. So it's a business which has grown almost 8x in the last 4 years. It's a company quite similar to another IPO bound company, Fractal Analytics. We are in the data analytics space. And in addition to growth in the business, which we are seeing 50% CAGR, 50% CAGR, our entry valuation is roughly 1/3 that of a Fractal. So imagine if we get the growth rate right, which is 50%, and we get the multiple right, we are looking at a massive outcome in this company. It could be a 5 to 7x kind of a deal if we really get it right. Then we have another company called Manjushri. Manjushri is a packaging company. 2,000 crores turnover in FY23 became 3,000 crores in FY25, growing at 24% CAGR. We have Shadowfax, which is a delivery company. They deliver literally everything, whether it is food, whether it is clothing, whether it is a quick commerce order. So 1,400 becoming 1,900, becoming 2,500 last year. This year we will touch 3,600 crores. And this is a company which is going IPO. They will list by February next year. And we are looking at almost 2x kind of a jump in the valuation in just 1 year. So these are big companies, scaled companies, and growing at 30% CAGR. Same thing holds true for our other companies. Niva Bupa, one of India's second largest health insurance companies, 4,000 becoming 5,600, becoming 7,400. This year we'll almost touch close to 9,000 with a 400 crores of profit after tax and growing at 35% CAGR. Purple, a beauty and personal care company, 800 crores becoming 1,500 crores. This year we will touch 2,000 crores, 33% CAGR. Then we have Devyani, which is a KFC and Pizza Hut operator, also growing at 25% CAGR. So you look at our companies, you'll find they are big companies, 2,000, 3,000, 5,000 crores kind of turnovers, and growing at the rates at which they are growing. So growth in the business, growth in the multiple, these are the two things, and very, very healthy on the portfolio, which is why our first fund, as I mentioned, is returning 30% CAGR. Very happy with the performance, both us as well as the clients. And now we have launched Fund 2, following on the success of the first fund. And given that we've tasted this success, we are going to continue with the same themes, the same strategy, just that the fund size will be larger. On paper, we are putting down 750 CR plus 750 CR of green shoe. But I think the existing re-ups from the first fund are going to take us through the 750 CR itself. We may try to exercise the full green shoe. We may see whether we want to cap it at around 500. So it could be a fund, maybe 1,200, maybe 1,500. I think the green shoe exercise we will see as we go along. The target IRR will be between 30 to 35%. This is exactly what we are tracking for our first fund. In terms of themes, continue with the same themes, the late stage theme, big themes, consumption, financial services, manufacturing, and the emerging themes, which are like the data and AI, the national priority themes like advanced manufacturing, sustainable energy, new energy. So the established or the late stage theme gives me that stability and predictability, and the emerging theme gives me that growth and alpha. The same thing that has worked for us in Fund 1, we will not change, continue with exactly the same playbook. Target companies, we will do only 8 companies. We call them best in class super companies, and I'll come to that, what is meant by that. Best in class companies are those, all 7 companies. Okay, one second. Sorry, there's a question here. Yeah. So this is, in case somebody wants to ask. So these are the 7 companies that we have done. Ilgin, a manufacturing company, 4,000 crores turnover. Sellable, data and AI company, 600 crores turnover this year. Manjushri, 3,200 crores. Packaging company. Shadowfax, 3,600 crores turnover. Logistics. Niva Bupa, health insurance, 8,000 crores turnover. Purple, Devyani, consumer companies, one in beauty, one in food, 2,000 crores, and 6,000 crores turnover. Was there any question, Sahil? Maybe I missed.
I think this is fine.
Yeah. Okay. So if you look at it, first fund we've done 7 companies. We will do maybe 1 more. At the outer limit, maybe 2 more. So 8 or 9 companies in fund 1. And this is the right mix. We will continue with our future funds as well. So the number of companies that we will take in the fund will be around 8. In an exceptional case, maybe 9. And there is the reason is that when clients come to me, I mentioned the problem statement is how to keep generating that alpha. The alpha will only come if you play concentrated. If you do 15 companies in the portfolio, I think you already missed the opportunity, because 5% in each company doesn't really pack it with a lot of conviction. We do each company with a lot of conviction, lot of commitment. So only 8 companies in the portfolio, which means 10 to 15% of the portfolio goes into every single asset. So best in class super companies, and I'll come to what is super, but concentrated strategy which can generate alpha. This I already explained the product features. Now, this is what a super company is. Super is our attribute, our definition of what a best in class company is, and it's an acronym. It stands for S, scaled, U, unique, P, profitable, E, exitable, and R, relative. So, like I keep mentioning, we do not do early stage companies. We only do late stage companies for 2 reasons. One, it's India's shortest private equity fund. If maybe the shortest, maybe one of the shortest, but it is a 6-year product where we need to return the entire money back to the clients with his return within that 6-year window. So we necessarily look at companies which are evolved and mature, which can hold an IPO even today, the day I invest. Necessarily between 2 to 4 years. But theoretically, if we want, we can list a Manjushri tomorrow. And secondly, we are doing unlisted companies. So one of the key questions I keep getting from clients is that, what if the IPO does not come? Oh, we keep talking about NSE IPO, NSE IPO is coming, but it's not coming. What do clients do? But I can honestly also tell you, I do not find any client who has got stuck in NSE. If you really want to exit NSE, for every 1 seller, there will be 100 buyers, right? Why? Because the buyer thinks that this is a great company, very profitable, and if not today, maybe 3 years later, the IPO will come. So I invest now with a 3-year time frame. So in a large company, there will always be a demand from the secondary set of buyers. So even if an IPO has not come, see, technically, we will try and start an IPO work within 2 years of my coming in, and it's a 6-year fund. So we are keeping a 4-year buffer in terms of the timeline itself. But for whatever reason, the IPO is not coming, I already have a ready list of clients, investors, buyers who can buy shares from me if the IPO is not coming. And that is the advantage of backing a large company. So today there is a huge pool of mass affluent investors, HNI investors, UHNI investors, family offices, and nowadays you even have secondary funds who only cater to the secondary deals. So they will never put money into the company. They are a ready pool of capital for me to exit. But for that, you need to be in a company where investors are or future buyers are comfortable. That's why scaled companies. And you saw most of my companies are at least 1,500, 2,000 crores kind of turnovers. So that is the sweet spot, minimum 1,000 crores. But for any exceptional company which comes, let's say it's an AI company, which is a new space, we may not find a 1,000 crore company. So we have kept 500 CR as the absolute flow, below which we will not even look at the company. We want to mitigate the risk for the client, and we want to do companies which are at least that size in scale when we come in. U is one unique attribute in the company which we find is unique in that company, in that business, which sets it apart from the rest of the competition. P is profitable. We will only go after companies which are EBITDA positive. In my entire 20 years of career, which you see here, you will not find a Zomato or a Swiggy no Byju's or Unacademy, no Vedantu or Unacademy or Byju's or Zepto, Blinkit whatsoever. So we only focus on companies which are EBITDA positive, and our money will go into the companies for growth, not to sustain the losses. It is exitable that, like I mentioned, we need to have an IPO within 2 to 4 years. So this is documented into our investment agreements, and it's an obligation on the promoter to deliver an IPO. We start the work on the IPO within the first 2 years. For whatever it's worth, if the IPO is not coming within 2 years, I still have a 4-year window with me in terms of buffer, because it's a 6-year fund. So we'll try in the 3rd year, we'll try in the 4th year. But in case the IPO is not happening at all, like I mentioned, we already have a secondary list of buyers available with us. And R is relative, that we will only pick companies if they are easy on the valuation multiple. That is, we get a multiple of 12 if the against a listed multiple of 20, so there's a 40% discount. Or the company is very high on growth metric, like a company like Sellable, which is in the AI business. We are growing at literally, becoming 8x in 4 years. Right? So this is a criteria that every company must fulfill before we consider them for the fund. We do 2 stages. I touched upon this: established and emerging. Established is where we focus on consumer. It's a company like Niva Bupa. It's a company like Devyani, which is old economy, traditional. This gives me that liquidity, predictability, stability, and these are companies which can IPO tomorrow if they want. Then the other bucket is the emerging bucket, the growth bucket, which gives me that growth and alpha, which is a company like Sellable or a Shadowfax, etc. So the established bucket gives me a 25 to 30% kind of an IRR, and the emerging bucket is designed to give me a 35 to 40% IRR, if you see on the right. And on the entire portfolio basis, the Super 8 portfolio, the 8 companies that we will do in the fund, is designed to give a 30 to 35% IRR on the portfolio level, which is exactly what our first fund is delivering. We are keeping the strategy same for the second fund, very hopeful of delivering the same for the second fund as well. This is just how profitable our companies actually are. Niva Bupa, 200 crores of profit after tax last year. Manjushri, 700 crores. Devyani, 800 crores. These are our established companies. Our emerging companies, Sellable, Shadowfax, Purple, look at the growth rates, easily in the vicinity of 40 to 50%. And the themes continue to be the same: the consumption, the financial, the enterprise, which are the old themes, and the new themes, which are the data, the advanced manufacturing, the energy, the emerging themes. Our filters are very high. So for every 250 deals that we have seen in Fund 1, we've only been able to close 6 or 7. So we have a highly tight filter because of this super criteria, because of this established and emerging criteria. Very few people, very few companies are able to pass that filter, and we have, for every 100 deals, only 2 deals that really end up getting closed. And if you see on the right hand side, there is a strong focus on proprietary deal flow. 30% of the deals that we got into the fund were directly sourced by the team, but out of the deals that were closed, nearly 70% of the deals that we actually did were sourced directly by the team. So if I had done 7 deals in my first fund, 6 of them were deals which were unique to me, which were proprietary to me. So there's a lot of effort that goes on our part to go out and look for opportunities. This is what my team does on a day-to-day basis. We track more than 500 plus privately owned companies of India, and we are knocking on their doors literally every other day, if not every other week, and trying to get this entry point. So proprietary deal flow is a huge focus for us in our portfolio. I mentioned upon this proprietary. We have a 3P engine. We call it primary, proprietary, platform. Proprietary, Just now I touched upon deals which are unique to us, where we know the promoter or the founder directly. Primary is that we will only put money into companies for growth. We will never buy secondary shares from any other shareholder. When we put money into the company, the promoter is answerable to us. We get all the management rights, access, we get all the protections, be it in terms of exit, be it in terms of liquidation preferences, be it in terms of minimum IRR, like I touched upon, minimum assured IRR in certain cases. And we have an advisory board of industry stalwarts, one of whom founded one of the largest investment banks in India, the other one, former MD with one of India's top private equity firms, and third one, chairman with one of India's top 5 IT services companies. These are senior people who are incentivized by us in terms of, if you see at the bottom, the number of deals that they bring to me, deal sourcing, the number of hours that they give to me, deal evaluation or portfolio review, and the outcomes that they create, the portfolio exit, where we share a carry with them. So it's a very heavily entrenched model where we work with our advisors to identify opportunities, to identify the gaps in those opportunities, and then take it to conclusion, make returns and share profits. And this profit share to the advisors comes from my pocket, not yours. So it doesn't impact any of the clients. It's a practice that we want to build for the long term, where we bring in the right talent and incentivize them to work hard for the clients. The third is platform, where we bring InCred to the portfolio company. We are one of the fastest growing financial services company today, InCred as a group. We have literally a hand in every side of the capital market business. We have in-house ECM, which is equity capital markets competency. We have equity research and stock broking. We have investment banking. We have wealth management, where we manage more than 3,000 families. So when we invest into companies, we are not just providing them with capital, we are providing them with solutions. So if a company is about to go public, we help them take it to the investors. If a company has already gone public, we commission research reports on these companies, and we take these reports to other investors to help generate visibility, to help generate interest in the stocks. So the promoters or the founders come to us, they talk to us because we are not just giving money, which is fungible, but we are adding value in aspects beyond capital. Again, proprietary focus, like I mentioned, look at the orange columns in the middle. Big companies, big valuations, but largely direct sourcing by the team. Whether it was a Manjushri or a Lenskart, whether it was an NSE or a Niva Bupa, these were deals directly done by the team, large companies. And we came in ahead of the market, without the involvement of any other advisor. I'll quickly shuffle some slides. I think this largely I've touched upon. So now we have launched Fund 2. These are the key terms. It's a Category 2 AIF, SEBI approved. 6 years from initial close, I already explained. We are raising anywhere between 1,200 to 1,500 CR. Focus on these 4 sectors: consumption, financial services, enterprise, and the sunrise teams, new age teams. We invest with the mindset of exiting between 2 to 4 years. Sponsor, the parent is investing 20 crores. Now, this is a specialized product because this is a Category 2 product. And as per SEBI, we need to have a minimum ticket size. And the minimum ticket size for a product like this is 1 CR. But again, I reiterate that this 1 CR doesn't need to come in one go. It comes over the next 2.5 years. So from, let's say, September 25, when we take down 10%, all the way down to December 2027, when we take the last drawdown. We've got 5 share classes: A1, A2, A3, A4, A5. These share classes are nothing but types of the units that we allocate to the investors. Just to be very clear, investors put money into the fund. They will get units in the fund, which will be reflected in their DMAT, and the fund will end up owning units, or the fund will actually end up owning shares in the portfolio companies. So investors own shares in units in the fund owns shares in the portfolio companies. And when we sell the portfolio companies, the fund gets liquidity from the share sale, and that liquidity is distributed to the clients, and we redeem the units. That's how the structure works. Quite similar to how a listed fund would work. But again, like I mentioned, our fees are very nominal. So we do not charge money on the AUM basis. We charge money on the commitment basis. So for the standard A1 and A2 categories, the fees is 2%. That means for every 100 rupees that the client is committing, we will charge 2%. And this 2% is also applicable for the first 3 years when we are investing. When we have started to return the money back to the clients, like I mentioned, we will start doing it from the third year. This 2% will not be applicable even on 100. It will be applicable on the balance capital. So if I've returned 40 to you in, let's say, fourth year, the 2% will be applicable on the remaining 60. Fifth year, it will be applicable if I've returned additional 40, it will be applicable on the remaining 20. So the fees keeps coming down as in when we keep returning the money back to the clients. And anybody, like I alluded to in the beginning, anybody who comes in before the initial close, even the first year's 2% goes down to 1%. So effectively, the first year fees is half, only the second and third year fees is 2%, and then the fourth, fifth, and sixth year, the fees keeps coming down gradually. So our incentive, unlike a listed fund, is not on making fixed fee. We are incentivized by profit share, and that profit share starts only when I make a 12% IRR for the client. For the standard A1 category, that profit share is 20%. So if I've made let's say 100 into 300, the profit is 200. Now on that profit of 200, my profit share will be 20%, that is 40 rupees. That means the client will get 260 and I will get 40 rupees. However, if we move from A1 to A2, and this is where I will definitely encourage each of you to really concentrate. If we move from A1 to A2, we can get into the maths later on, but if at a very high level, if you move from A1 to A2, the profit share reduces from 20% to 15%. That means for the same 100 which has become 300, an A2 investor will only see 15% of the 200, which is 30 rupees. So the first fund, the first A1 unit investor would have got 260, but the A2 investor will get 270 because my profit share has come down from 40 rupees to 30 rupees. So I'll encourage each of you to do a A2 category because there the fees are much better. And again, the money has to come in stages. So it's very easy in terms of the drawdowns, but the profit share makes it even more attractive for an investor like you. We've got a very good, healthy pipeline for the second fund. The first deal I've already touched upon, Ilgin, which we've taken. Last year, they were at 3,000 odd crores of revenue with 400 crores EBITDA. This year will be 4,000 odd crores plus 450 crores of EBITDA. This deal is already signed. This will be the first deal for the second fund. Then we are offering term sheet for a second company, which is in the jewelry space. Again, a big company. 5,000 odd crores of turnover with about 230 crores of EBITDA. This is also a pre-IPO company. They are going to file their IPO by next June or September. And again, we have a minimum assured IRR of about 30 to 35% going into the IPO. Big companies, profitable companies, near-term IPOs with guaranteed, quote-unquote, guaranteed or assured IRRs heading into the IPO. We've got a dairy company, we've got another AI company, we've got a medical diagnostics company. So pipeline is looking very attractive, very healthy. Again, we only have to do 8 companies. We've already done 1. Second, we are offering term sheet today as we speak. And we have got the next 2 years to keep doing the deals. Every 3 months, we will end up doing 1 deal and keep calling on the money. And the good thing with us is, we do not take your money and then sit on it and then look for the deal. We first go in the market, look for a deal, secure the deal, sign the deal, and then only we call on the money. And every 3 months, our team is out in the market every 3 months looking for that deal. So my March deal, we've already sort of started and sent the term sheet today. I mean, we are sending it today. So we have a 6 months window to close the deal, but we've already in advanced stages where the term sheet has been offered. Similarly, for the deal which will happen in June next year, my team would have already started work by December itself. So we are hunting in the background all the time with the target that every 3 months we do the deal, call on the money, and then deploy for the first 2 years and start returning the money back from the third year itself. First fund is delivering exceptionally well. Clients are extremely happy. We are sitting on 150 CR already in the last 4 days and looking to hold the first close very, very soon. I encourage you to consider this highly, eagerly, and try and look at the A2 category where the profit share reduces. Come in before the first close happens so that you can avail of that early bird discount. Any questions, more than happy to address. We've got Sahil maybe about 10 minutes or maybe 15 at the upper limit. But any client, any questions, if I'm not able to take today, more than happy to jot them down, and we will get back to all the clients, by tomorrow.
Thank you, Vivek. Really insightful discussion and presentation on private equity strategies, and especially InCred Growth Partners Fund. So, for all the attendees who are there in the session, you can always type your queries at the bottom right. There is a question mark. You can type it out, and we'll try to address. And like Vivek mentioned, if anything is left out, we'll come back to you at a later stage. We'll address those. Vivek, in the meanwhile, few questions have already lined up. So I will just read them out and you can address them.
Sure.
First one is the targeted return 30 to 35% net of expenses?
Yeah, so net of expenses, the target return to the investors will be depending on the ticket, like I kept mentioning, because I can't quantify the return without knowing the asset class or the share class. So the portfolio will make 30 to 35, let's say 32.5 blended. The return net to the clients after the fees, expenses, etc., should be in the range of 25 to 30% depending on where the client lies. If it's an A1 category investor, it should be between 25 to 26. If it's an A5, let's say, it will be closer to 30. For A2, it will be in the range of 26 to 27. These are pre-tax returns, and taxation I kept mentioning, most tax efficient product. So we are looking at 12.5% long-term capital gains.
Great. Second question, in terms of the funds, we have IGPF1 and IGPF2. Is there going to be any overlap between the companies where the investments will be done?
Yeah, two overlaps. One will be ILJIN, because ILJIN is a big company. They were raising 1,500 crores. So we had to minimum subscribe to at least 100 crores. Otherwise, the deal was not available. Now, 100 crores I could not have done from my Fund 1 itself, because Fund 1 is 600 crores. And I typically do not like to go beyond more than 15% of the fund into any single company. So we use Fund 2 as a support for the Fund 1. And the Fund 2 investors get a very good deal readily available, where the deal has already been signed and they just need to participate. So the Fund 1 investors benefited from the capital of Fund 2, and Fund 2 investors benefited that the Fund 1 had already spotted a deal, secured the deal, and they just need to participate. And we will do one such more deal where, with the objective that we are able to write a larger check, maybe at 80 crores from Fund 1, maybe about 150 crores from Fund 2, where we can go in with about 200 crores of a commitment and try to extract better terms with a larger ticket.
Great.
So two overlaps.
Okay. Next question is, I think you might have addressed in the presentation also. Is there a defined minimum capitalization of the investment companies and upper limit also, or you can go in any range?
Defined minimum capitalization of the companies? No. So in terms of, if somebody is talking in terms of valuation, so valuations are, all over. If you ask me, an urban company with a 12 crore profit can trade at 25,000 crore market cap. Now, whether that's a company I will consider, we will not look at market cap as such. We will try to look at, the fundamentals. So our thesis is more in terms of a revenue threshold and an EBITDA threshold. Market cap is eventually a derivative of how these numbers will play out. So we are focused on financials, not so much on valuation.
All right. And one basic question I would say, if someone wants to withdraw money during the 6 years of the fund cycle, is that possible? And what are the options?
See, Upfront, I'll be honest, we do not encourage clients to participate in case you feel that you may have to withdraw within the 6 years. This is a fund where we need your time and support for the money to grow. If you participate and then choose to withdraw within 3 years, the money would not have grown only because we are deploying for the first 2 years. It takes time to compound, right? So honestly, we do not entertain, we do not encourage this during term kind of a withdrawal. But having said that, in case a client has some emergency, there's a medical problem or some other sort of issue, we are happy to facilitate a trade. We managed more than 3,000 families within India. We are happy to look for you a buyer. And even from your side, if you have another buyer who wants to buy from you, we're happy to facilitate the trade. I'm happy to meet with that buyer. I'm happy to give him all the comfort on the portfolio, how the companies are doing, when are we going to see the exits. And the trade will happen around the NAV price. We have an NAV which is coming out every 6 months. And this is done by our auditors, Grant Thornton. And the trade will happen between the buyer and the seller around that NAV price.
Okay. A follow-up question to earlier on the IGPF 1 and 2 series. Is there any kind of overlap percentage between the two series that you have in mind, or is that something not there?
No, like I mentioned, there will be two deals, right? So percentage you can't define because the fund one ticket size of ATCR maybe it will be 15%, but the same ATCR for fund 2 will be only 7%. So we don't have a percentage, depends on the size of the fund. We are saying that there will be two such opportunities, and we want to do this intentionally so that we can secure a larger ticket and command better terms while going in, right? This is exactly what we have done in Elgin. We've gotten a sweet deal, like I mentioned, a minimum assured IRR to the IPO, near-term IPO in the next 15 months. But we needed to do at least 125 CR kind of a commitment to secure that transaction. So we anticipate there will be one more such opportunity where both the funds will collaborate. And remind you, there is no conflict because both the funds come in on the same time, same terms, right? So it's not like fund 1 has gotten better terms or better pricing. It's exactly the same terms and times.
Okay. Another query, is there a, like in market cap terms, you said that you are comfortable and it depends on the opportunity. On the other side, is there a minimum percentage of the company that you are looking to take, or is there a maximum percentage limit that you have, that you won't go beyond that, or you won't go below that percentage?
So maximum, I think, again, the range depends. So like, for example, Manjushri, we have worked with other investors. We have bought literally 100% of the company. Okay, over 90%. In other cases, like a case of sellable, I'll be around 5%. So it really depends on the size of the company. If I'm writing 150 to 200 crores kind of a check size, let's say for a company which is about 2,000 crores, I'll be roughly owning about 10%. Okay. It could be 5, it could be 15, but again, it depends because my check size will be about 200, maybe 150. So it really depends on whether the company is 1,000 crores or 2,000 crores or 3,000 crores, which will dictate what the stake will. But having said that, we do primary deals, so we take all the rights. So whether it's a sellable where I have 5% or a Manjushri where I own along with other investors more than 90%, I will have all the rights. We will have full face time from the promoter and his management team. We have access to monthly information, the entire P&L, balance sheet, etc. We sit and meet with them every month. We have good visibility on how the operating metrics are. We have all the protections, whether it is in terms of minimum IRR to the IPO, whether it's in terms of when the IPO will come, who will be the IPO banker. And in case, worst case, IPO is not happening, I can sell out my company. I can drag the company for an M&A activity. I have liquidation, preferences. So regardless of the stake, we will have all the protections built in.
that addresses actually one other question which someone else had asked. Moving on, are there some particular sectors that you have in mind that are clearly not where you will invest, like complete exit? You will not take ownership in those sectors.
We will not do real estate. We don't understand that. We will not do pure commodities. Again, these are global cycles, very difficult to predict whether it's going up, going down. We will probably stay away from heavy infrastructure businesses, which require a lot of time and capital. And more than the business itself, ultimately we also look at whether the company is profitable or not. So any business or any company which is requiring money for loss funding, straight no. Money has to go for growth.
Great.
Sahil, kind request if you can wrap it up in 3 minutes. I delayed my call to 5:15, so just need a 5-minute changeover break.
No problem. Just one last question, and then maybe we can close the session and take other questions later on. In terms of the payout, you had explained that there is a certain IRR percentage that will be there. There is a question on how the cash flow will look like. If there is any slide or presentation we can maybe share, or maybe we can address it later on, depending on.
We have an Excel. My team can share an Excel where we capture how the cash flows come in and how the distributions happen, and how does that cash flow translate into IRR.
All right, because that is
I can share it with you and Susmit and the team, and whosoever client has a query, we can get into a call, or the RM can explain it to the client.
All right. Okay. I think majority of the questions are addressed. However, if the attendees have any queries, questions which are still not answered, they can reach out to their RM. Like Vivek mentioned, we'll be more than happy to address those. And he is also volunteering to even come on call if there are some specific queries where clients need more details. We can set it up. You can all reach out to your RMs, and you can get any unanswered queries raised there. Thank you, Vivek. Thank you so much for taking time out and addressing us very well in terms of explaining the benefits and nitty-gritties of the private equity strategies. Thank you so much. Thank you everyone for joining us today. Great.
Yeah, thank you so much. Look forward to meeting with you and looking forward to having you on board as investors. Any questions, please do reach out. Feel free.
Thank you.
Bye.